All right, it's 11 o'clock and welcome to the 20-Minute Annuity Tuesday. My name is Trent Zimmermann and I'm the Annuities Director here at BGA Insurance. I have a background with a bachelor's in economics, a master's in finance. I'm a chartered financial consultant and chartered life underwriter. Now, BGA is a wholesaler for life, annuities, and long-term care, as well as disabilities, servicing independent agents all over the country. And today we're talking about how the time is now to sell annuities. So let's get started. First off, we're looking at increase in annuity sales this last quarter. And why is that? Why are more people looking to annuities now more than ever? First reason is record-breaking renewals for these contracts that are out. So let me launch a poll real quick. How much do you think is coming up for renewal in MYGAs alone this year? 10 billion, 20 billion, 60 billion. Go ahead and put your vote in. And I know we have a lot of repeat customers here for the Annuity Tuesdays, and most of you are getting it right. We've got 2/3 of you saying 60 billion. We're looking at $60 billion of MYGAs up for renewal this year. 40 billion in annuities altogether sitting outside of surrender. So we're looking at why people are looking at annuities. Now, the easiest reason is rolling over. You're able to roll over a massive amount of annuities that are out of surrender, and when they're out of surrender, one of two things happen. If you're in a MYGA, you're either going to be put in the fixed bucket that's going to be an annual rate, or you're going to be rolled into a new contract that's not commissionable to you. If you're in an FIA or a RILA or a VA, once you're out of surrender, those rates usually tank. You're not going to be getting the same cap rate that you were before because now you're moving into a shorter period of time that you're buying that debt for, so you're going to have a lower amount to spend on those options. So the rates are going to tank. So if you aren't having these conversations with your clients, someone else is. Next reason we're looking at is peak 65. Now, we've talked about this before. It's a historic demographic milestone in the United States spanning from 2024 to 2027. The amount of retirees is going to explode. And the need for retirement planning has never been more important. Now, if you've joined these before, you know what I'm about to say here. There is a number that you annuitize. That means you will never outlive your money. The core expenses are going to be covered. The chance in a Monte Carlo analysis of portfolio depletion is less than 1%. And greater than 75% of historical backtests, you're going to show a greater terminal portfolio size at death by having an annuity, and you're going to eliminate core concerns. Why? With assets under management, you have unknown growth loss. And the safe income payout because of that is going to be 4%. In annuity, you're going to get a guaranteed 6 to 12% growth on roll-up and a guaranteed payout of 7 to 8.5%. Why isn't this something you would want in your portfolio? None of me is saying replace everything with an annuity. That is a bad decision. But this is something you add into your portfolio to increase the amount of income payout, increase the amount, or guarantee the amount of growth so you know exactly what you can retire with. And it gets rid of the secret return risk. We've looked at Mr. Green and Mr. Red before. We're looking at two different scenarios, just inverted. And if we look at 2000 to 2024, this individual runs out of money at 79. If we're looking at 1998 to 2024, so that you're not starting off with 3 down years, and instead starting off with 2 up years before those 3 down, you still have significantly less than Mr. Green, where you start off with a better sequence of return, but you're not running out of money. So we want to eliminate this risk, and we can by adding annuity into your portfolio with this peak 65. Morgan Stanley, BlackRock are all publishing more and more data about this and building this into the retirement plans that they have set up that you can get annuities. And the reason is because they've launched these 10-year global investment office studies, and they found that just having an annuity, not even an income annuity, having an annuity in your portfolio increases your probability of sustaining income over a 30-year retirement by 19%, and minimum having a 10% higher terminal wealth. And because it fits into this Dr. Fow's retirement income style awareness structure. So the people with the most success in retirement are those who have some sort of guaranteed income. I put an income annuity because that's what we're here to talk about, but it's also now becoming the most common way to guarantee income. Some sort of time segmentation, taking money out, making sure that it's going to be there when you need it. And then equity growth, your traditional growth portfolio, and then some sort of risk wrapper so that you can take money out of the risk wrapper when you're in down year in your traditional equity growth. And so next, we're looking at reason number 3, rates. Let me launch another poll here. Where do you think rates are going to be going? Do you think rates are going up or down? All right. I'm going to give you a couple more seconds to answer this question because we're pretty evenly split. We've got a 60-40 split, 60% saying up, 40% saying down. So rates right now, for the history of people buying annuities at peak 65, are pretty high. Now, rates could be going up higher, rates could be going down. The Fed split and you guys are split. But we learned our lesson from the 2020 to 2021 period and going into that of near zero rate period, and people built this fear of annuities. And I even heard it yesterday that somebody had an annuity that they bought back in 2016 that barely did better than the CD. And we're now looking at a point when interest rates have come up, and we're not sure if they're going to go up or down. But the good thing is the annuity rates more closely track the 10-year treasury than the Fed rate. And the Fed rate, although married with the 10-year treasury rate, they're not closely tied. So we're on this upswing. We're doing pretty well. Rates might continue to go up. They might start to go down. We've got a time buffer here that we can pick up these rates while they're good. And we can possibly get some more if they get better, or we can hold with what we've got. And instead of putting this money into bonds that can go down and have been, as of late, correlated with equities going down at the same time, you can get something that's going to be guaranteed. So unless you're planning on holding these bonds, you can get something that's better so you're not having to sell them down here. And if we compare annuities right now to the MYGA rates, we're getting a little bit better result out of it. We're getting 5.5% to 6% out of these MYGAs. And I'm sorry, I flipped these. And with the fixed index, a historical average of 6.88, compared to these bonds, doing pretty well. The only one that you're losing out to are these long-term government and corporate bonds on the MYGA side, but the FIAs historically have done better. So rates are good right now. We have caps up to 9 and 10% on the FIAs, and we talked about MYGA rates at 5.5 to 6. You can do very well in these products. And these fixed index annuities, the way they hedge these is going to be based on those rates as well. So why not pick up them while the getting's good? And you can do what we've talked about here before with the essentially a treasury bond ladder, but with annuities. You can buy a 3-year MYGA, a 5-year MYGA, a 7-year FIA, maybe even a 10-year onto there, and grab up the rates while they're good. And if you're wrong and you said they're going down and they end up going up, well, at least you have a 3-year MYGA that's going to be up for renewal pretty soon that you can capture the better rates on. But if you said up and you were incorrect and they're going down, at least you don't have your whole portfolio coming up for renewal in 3 years now. You have tranches that are going to be coming up, and so you can guarantee a higher guaranteed rate over a long term, or a higher cap rate over a longer term period by doing a ladder structure. So I'm sorry, I put rates here as a second time, but I meant to put the market. So forgive me there, but I'm going to launch one more poll here. Where do you think the stock market's going to go in the next 48 months? Do you think we're going to undergo a correction or a recession, or do you think we're going to keep going up? Wow. All right. I'm going to end this poll in just a few seconds here to get your answers in. I need to share this with you guys. I'm going to kick this back on you. 80% of you are saying yes, the market's going to undergo a correction and recession in the next 48 months. That's a large amount of you guys saying that there's going to be a correction. And the data is backing you up, not on an economic forecasting piece. I'm not going to go on that. I'm not the person you want to be hearing on that. And if you do want to hear me, you can call me and I'll chat your ear off for far too long. But with this last quarter being gangbusters for annuities, when they survey the people buying these annuities, the number one reason they said by an overwhelming majority was they feared a massive correction or recession in the next 48 months. The last 10 years, though, have been fantastic. So why not take some cream off the top and protect it? And at the end of the day, I didn't really care what you said in this poll because the idea stands. If you were with us on our client profiles, we looked at Al Aggressive, who sees the value of being aggressive and staying in the market, fears pulling money out in a down year, and hates the idea of systematically de-risking or hedging. And even though they don't want to take the cream off the top and put it away and make sure that grows and make sure they're holding on to it for when they need to use it in retirement, baseline income means they would never have to sell in a down year. Low to no sequence risk means they can take on more risk. They don't have to hedge with a 60-40 blend. And they can live on alpha once that income is annuitized. They're living off of gain at that point. And so they can get an FIA with a guaranteed lifetime income rider in order to stay in that market for longer. And maybe even these are the people who are saying that there is going to be a correction in the next 48 months, or there's going to be a recession. Why wouldn't they want to take some money out and put that into some guaranteed income and then be able to budget and make sure that when that correction happens that they're predicting, they can dump more in? So even though we're talking about Al Aggressive, it might not be Al Optimist. If you have clients who are aggressive in the market, but fear this correction, fear this recession, an FIA with a guaranteed lifetime income rider can mean they can stay in that market for longer, and maybe they'll double down in that market when the correction comes because they're not having to worry about how much of my money do I need to make sure it's protected because I have guaranteed income source. We also looked at Carl Conservative, and just in this case, we pretended that he lost a large amount of money in 2008. Been conservative ever since. Because this is a story we hear on our side a lot. That they want to be in an FIA, a stock market with training wheels is what a lot of people call the FIAs. And they panic sold in each downturn. They decided that I only lose money in the market. Why be in it? So they've invested in CDs and treasuries. So they're underperforming the annuity market. So the non-liquidity of annuities and the guaranteed rate or 0% floor, it's going to prevent them from panic selling. They can't sell in down years anymore. They've got to wait to the end of the year, the anniversary, in order to change their allocations. And annuities will perform their current portfolio because of that. And because it will provide more upside because they're not dealing with the fear. So having MYGAs and accumulation FIAs in their portfolio will be a good thing. And so if we look at just the landscape, we've talked about this research before. I've got 5, 6 Nobel laureates here. We're all talking about the same thing. Can't time the market. Bubbles are only obvious after the fact. We have a disproportionate sense of loss. And staying invested leads to better gains. And we have this admission from Harry Markowitz, who created our modern portfolio theory, that this was never designed for households. This is designed for long-term time horizons for companies with indefinite time spans. So this consensus that annuities often outperform retail investors because it removes this loss aversion. Buying income allows for taking more risks. Insuring for longevity can lead to longevity. I mean, that one's not as applicable, but we can get rid of sequence return risk because it's a greater risk than we ever give it credit for. This works for both Al aggressive and Carl conservative and can benefit both people if they're optimistic about the future or concerned about the future. It can help them stay in the market longer, or it can help them take cream off the top and make sure it's protected. And why do I say this? Outside of just Nobel laureates, because when we're talking about putting your money where your mouth is, Ken Fisher, the guy who says, I hate annuities, owns them himself. Warren Buffett, one of the best investors of our time, is bullish on annuities and has two rules. It's insane to risk what you have for something you don't need, and now is the right time to pull the cream off the top. And we talked about Morgan Stanley study. BlackRock has talked about how annuities are the future of retirement because of this study on the psychology of investing. Get rid of the FOMO, loss aversion, action bias. And we're going to go back to this slide we had before about the sequence of return. What if we could take this off the table? What if we can make this not a worry so that you can stay invested, you're not pulling in down years. You're not creating this volatility drag where that you lose 10%, you now need to make back 11, you lost 25%, now 33. You add the 4% safe money out of there, you add a fee, and now you've lost 30%, you need to make back 43. That is a costly loss. So building into your portfolio something that can guarantee income, something that can do some time segmentations and pull tranches out to make sure that they are there and maybe have some guaranteed growth in there as well. And having something as a risk wrapper that you can pull out instead of pulling out of the portfolio and down here is going to make it so that you're going to be able to weather the storms of a downturn, maybe even double down in a downturn, or make it so that you can stay invested in the market longer if you are optimistic. And so I'm sure you all know how caps and pars work, but just as a refresher, this is how they're going to work. Of that, if we had a downturn next year, and this is a true sequence of returns of 19.44%, and you were completely invested in the market, and we had an upswing the following year of 26%, you would have made 2%. So if you had something in your portfolio that had a 0% floor and a 10.5% cap, you would have made 10.5%. If you had something that had a 60% participation rate and a 0% floor, you would have made 16% in that same period. So even though we talk about annuities as likely not beating the market, there are situations in volatility, in high volatility situations, that these can outperform. And if your clients fear that this is going to be the future, this can be something financially prudent for them. And there are even products, FIAs, that will have 3-year durations. And in those 3-year durations, they will even have ones that have fixed rates of 8.5% in the first year. They openly tell you they're going to crash that rate the second year, but they'll guarantee 8.5% in year one, so you can weather this if you think it's coming in the next 12 months and actually have a gain, and then go into an 8.5% cap from there on out. And so we can see if we're looking at Al investive, Carl conservative, Mr. optimistic, Mr. pessimistic, now is the time to put money into the income annuity, the time segmentation, the risk wrapper, to make sure you're taking cream off the top. These last 10 years have been gangbusters. And if your clients have been anywhere near the market, they've made a ton of money. And if your clients are in that peak 65, they're getting ready to retire or they are retired and they're trying to make their money last. And the rates are good right now. And why not take those while you can and start making sure that you have these 4 tranches built out so that your clients will pass away with 10% more terminal wealth. I'm just going to show you this. This is the research from Jeremy Siegel, the longest term research we have on the market that shows that being in stocks longer is going to be the best way to hedge against inflation and make the most wealth. Why not make sure you can do that and have this portfolio freedom effect where instead of a 60-40, you can put 100% in equities. You can go into global stocks. You can go into real estate stocks. You don't have this panic selling anymore. You're not forced to sell in the down market, and you're going to slow the AUM depletion rate, and maybe even grow the AUM if you're an assets under management advisor. That you have a high likelihood that you're going to make more money on the assets under management by building these 4 tranches. So when's the best time to plant a tree? 100 years ago. When's the second best time? Today. And I know we're at 20 minutes, and I forgive you if you sign off here, but I'm going to jump into this real quick. That have a script, I'm sorry, and use the fact finder. I screwed that one up there. I'll get you the scripting, but essentially, do you have any CDs or bonds that you want me to review? Do you have any annuities you want me to review? How would you be interested in a personalized pension that can guarantee income for the rest of your life? Type of questions built into your scripting on how you deal with clients on a daily basis. You have a fact finder ready. We can get you one if you need one. So if they say, yes, we want to review these, let me get some information about your life and your retirement that you're planning on. Build some guardrails. Limit the options. Don't come to me saying, I need to see options at 100,000, 200,000, 500,000, $1 million at 1 year deferral, 5 years deferral, 10 years deferral, and overwhelm your clients with every different illustration possible. Know their goals, give them 2 to 3 solutions, bring your expertise without complication. And remember, as we go into this, illustrations only prove that ink sticks to paper. You can have private equity owned FIAs that are going to tank the cap and pars in the next year. You can be in volatility control indexes that offer a 3 times multiple on whatever the index does, but the index performs at 1% every year. So build happy clients by knowing the renewal rates, and we'll be these experts for you on the back end. Talk about private equity ownership. We have things like alert scores we can get you that are going to be more forensic than the S&P and Moody's. Avoid volatility control indexes, beware of the surrender charges. Build this around what your clients are actually looking for. And that's what the scripting and the fact finder bring, and working with us to build some guardrails so they're not looking at, well, that illustration looks great, but you and I both know it's not going to ever perform that. And then perform annual review. Always perform the annual review. Because we had a gangbusters year, or quarter this year. And we had a gangbusters year in 2023 when rates jumped for the first time. Is anybody checking on those clients now? I can tell you from what we're seeing, we are seeing repeat customers buying or rolling over their annuities 1035 exchanges with different advisors the second time around than they had the first time around, because they weren't doing annual reviews. So do the annual reviews and make sure they're happy. If we were wrong, if they ended up tanking the rates, can you reallocate to a new index within this? Absolutely, do it. Be on top of this. Work for your clients' benefits. And if at some point, they're really in trouble and they're several years in, which we've had advisors do, and they're honest with their clients because they put them in something that looked sexy in the front end, we can get you a better bonus that's not going to be the free money, massive charges, volatility control. We can get you something that can get them out and put them in a better position. And because you have happy clients, you've built this out, and you're working within a system of the 4 pillars of retirement. You got to ask in each stage of this for referrals. You're building something good. You're building what the data says is the best way to retire. And you're making sure your clients are happy all along the way. They're going to recommend people similar to them with similar finances to them. And now you can build a pipeline off of this. So this last quarter was gangbusters. And I know we're 4 minutes over, and I'm going to touch on one last piece. A lot of that was in RILAs and VAs. VAs does not protect you from the downside. The variable annuities, there's no downside protection. The RILAs, the registered index annuities, those offer some. They buffer the loss. You still can take some loss. And if you have the biggest buffer and the biggest upside, you're going to be locked in for a 5-year term or longer. And if we look at that sequence of return where you had 3 big down years and 2 swings back up, you would have finished flat. That doesn't help you in that situation. might as well have been in the market. And when you look at 1-year time horizons and the large buffer, it's going to look almost identical to FIA except with more fees. Do you have the tools available to you to say, we have guaranteed rates, we have fixed index annuities, we have principal protection, take some cream off the top? RILAs can be great tools, VAs can be great tools. But in what we're looking at right now with a gangbusters last quarter for annuities, with the number one reason being that people fear a downturn, they just got put into stuff that you can make fees off of that probably aren't the best for these types of situations. If that's truly what they fear. The reason you want to be in those is because you think it's going to go massively up. And you want all that upside that you can't get on an FIA. But even then, there's other strategies, building guaranteed income, that can make you stay in the market for longer and get that upswing. So, here's my information. Call me if you need the fact finder. Email me if you need the fact finder or if you want the scripting. And remember, it's a gangbusters quarter. Take advantage of it. We've got another quarter where rates just went up again. We saw that across our MYGAs. There is more renewals than ever. There are more people approaching retirement than ever. Rates for those people have never been better since they've been in the annuity market. And there is a real concern of a downturn. And some people that it's going to go up. But either way, these tools can be part of that 4-pronged structure to protect their retirement and give them the highest opportunity for the highest chance of success and the highest terminal wealth to pass on to their heirs. Thank you for joining. I know this is our 26-minute Annuity Tuesday, but thank you for joining. I'll see you again next Tuesday. I'm going to hang out, see if you have any questions. But with that, I'll see you next Tuesday.